All unicorns here today.
We have the founders of the 100th unicorn of India.
And in less than 18 months, the company has tripled its valuation.
There's so much of energy, vibrancy and dynamism in our startup movement.
कल के स्टार्टअप आज के यूनिकॉर्न बन रहे हैं.
First, the startup boom.
Startups of the US are building centers in India.
और देश के छोटे शहरों में भी, टियर 2, टियर 3 सिटीज में भी नए-नए स्टार्टअप बन रहे हैं.
And then the layoffs.
The second layoff comes after the company fired 600 workers in April this year.
A freeze in hiring, about layoffs taking place.
Layoffs in India's online education space continue.
And now the startup scene finally seems to be stabilizing. They are not aggressively hiring, but looking for talent. The job market is hot with offers and perks. Perks like giving free spas to your dogs, even international holidays. Startups are doing anything to retain and invite talent now more than ever. So if you get a call, what should you do? How to evaluate a startup offer, how to calculate the risks in a startup job, how to tell a good startup from one you should stay away from. Let's tell you all that in this video. First up, like always, please remember to like, share, subscribe, press that bell icon so you keep getting notifications every time we do a new video. Some basics. But if you already know the basics and want to directly go to salary negotiation, you can skip this and go to the next chapter. To start off with, here's a staggering number for you. The total number of recognized startups in India are 72,993 in 2022. The success rate, however, of startups remains very low. An IBM study found that 90% of the startups fail within the first 5 years of its inception. That is 1 in every 10 startups actually which get to taste success. That makes working in one a high risk and high reward job. Their success or failure hinges on finding the right team, and thus startups are aggressively looking for talent, especially once the funding is locked. But startup pay structure is complicated. So before you say yes to a startup job, know this. Equity, equity, and more equity. It's all about that. Well, you might be compensated handsomely by the startup in terms of your monthly salary, much more than your corporate or MNC job, but don't fall for it. Salary is not what you should settle for. Startups do lure candidates into offering equity, which, remember, is kind of your hissa in the company. What percentage of the startup you will own is what your equity really is. Let's understand this simply. Say the startup is valued at 10 crore rupees. The founder offers you 1% equity and then you own shares worth rupees 10 lakh. Simple? Not really. Now starts the tricky part of holding the equity. The first point to remember there is, with every round of funding, your equity will get diluted. So let's say that in the next round of funding, the valuation of the company has increased to 100 crore, but 20% of the startup has further diluted to raise funds. Your equity will also be diluted down 20%. So from 1%, you're down to say 0.8% now. But this isn't really bad news, because since the valuation of the company has now increased from 10 crore rupees to 100 crore rupees, 0.8% of 100 crores will be 80 lakhs. Suddenly, instead of owning just 10 lakh rupees worth of shares, you have gone to owning 80 lakh rupees worth of shares in the startup. It's about 8x just in one round of funding. So bottom line here is, what's important for you is not just the percentage of equity. What's important is what stage of the startup that the equity is being offered. Second point to remember, the ideal ratio of your salary to equity should be 2:1. If the annual salary offered to you is say 50 lakh rupees, then the equity offered should be roughly worth about 25 lakh rupees. This is important. Why? Because since your salary may see a hike of say 10 to 20% every year, your equity could see a rise of 70 to 90% with every funding round. Or not. And that's where the next point comes in. And this is probably the most important part of holding equity. Remember these two words I'm about to tell you very, very carefully. Strike price and vesting period. So strike price is actually the price at which you're offered the stock option to buy and sell. Meaning, It's a future set price at which you can realize or cash out your stock. Yes, that price is actually set and thus very critical for you to negotiate that figure. It's like your life jacket of sorts. In case you wouldn't like to keep the job, you're not happy, you want to exit, well, that price will determine your equity value at exit. Another key component is your vesting period. Vesting period is what startups have introduced to retain new employees. It is essentially the length of time that an employee must wait before exercising their stock option at their set strike price. So if you are given, say, 1% of the equity, they will divide that equity over a period of, say, 4 years and give you the option to buy that equity at that strike price, thus locking you in the company for at least 4 years. And an earlier exit for you would basically mean loss of that equity. Now, don't worry, startups are not trying to trap you in this or anything like that. This is an industry standard, generally varies between 4 to 5 years. All right, having understood that, let's move on to the next point. After equity, the various combinations, the next thing that you really need to be thorough about is how the startup intends to make money, i.e., what's their business model. So everyone knows this fine. Now we all do our basics and we Google and we search and we stalk and we talk to employees, former and current one. Try to gather all the information there is really about what the startup is about. How much money have they raised? Where is the money coming from? Is it backed by a VC? Who are the major investors in all of this? You know all of that, right? But apart from these basics, there are 4 critical calculations. If you are smart, you will take into consideration before taking up a startup job. These are runway, burn rate, business model, and revenue roadmap. Now, what is runway? It basically means how many months the startup can keep operating before it's out of money. So longer the runway, the better time for you to enter the startup. Burn rate? Well, burn rate is the pace at which the startup is losing money ahead of generating any profits. So a healthy startup is the one with a very low burn rate. Business model. Well, in simple terms, a business model is a plan that startups have of actually making money. You can't, after all, depend on funding forever, right? And then comes the revenue roadmap. A revenue roadmap ensures that the startup works effectively towards achieving the goals and measurable results. Now, a lot of this information Google might not be able to provide. So you have to ask. You have to ask in your interview. Consider it a Shark Tank, but in reverse. After all, you're putting your job security and in many cases personal sanity at stake for working at a startup. Also remember some hygiene checks. Don't focus on profits, focus on startup growth rate. Remember that a startup valued at 100 crore is not expected to grow as exponentially as compared to, say, a startup valued at 10 crore because smaller companies have more room to growth, remember. Also, apart from just looking at the financials of the company, study the product or the service that the startup has to offer. That is crucial. What exactly is the potential, the market opportunity, visibility, viability of this company? Is there a demand for a service or a product like that? And next, what you should keep in mind is the all-crucial company vision. After the company's money comes the company's mission and the vision.
So our vision is to make a workplace, help build cultures where employees love to come to work.
You might be having a vision in life, right? Where you want to see yourself in, say, 2 years, 5 years, 10 years from now. Same should be for the startup. Remember the most cliched interview question? Where do you see yourself in 5 years? When being interviewed, ask them the same thing. It's critical for you to know where the company is headed. Sample this. Do you know YouTube? Yes, where you're watching this video. This was initially launched as a video dating website and they pivoted. Well, we all know where it is today. So for startups, pivoting to other business models could actually work, but it needs to have a well-defined vision. Startups at an early stage sometimes pivot to different business model, optimize their earnings, and that, my friend, is a good sign. Don't think they're confused. This basically means that the founders are taking feedback and working towards a product market fit. Okay, and last but not the least, and frankly, this is something you should be asking for any job that you take, not just startups, and that is clarity on your role. ensure that you're transparent. Be clear about what you bring to the table. How exactly will that be utilized? Jot down your work-specific KRAs, your key responsibility areas there. Also, ask for your team structure. Ensure that you get a clear-cut understanding of the company culture, work timings, vacation policies. But hang on, even before you ask those questions, know this. If you are looking for a 9-to-5 job, startups is not the place for you, my friend. But if you are someone who hates the restrictions and limits of a corporate job, feels like you have so much more to offer than just what your defined role is all about, you are exactly what the startups are looking for. High risk and high reward. Working at a startup is like taking a plunge. And you know, while we were researching for this video, I spoke to a friend of mine who owns a startup and he described it perfectly. He quoted Paul Graham and said, building a startup is like taking a leap of faith and figuring out how to survive on the way. So those are some of the crucial things you must keep in mind before you say yes to a startup job or a startup way of life even. That's it from us, but leave us comments on what you think is the biggest thing that stops you from joining a startup. Hope this video was helpful. You can like it, share it, subscribe it, send it to all your friends. Let's listen in to a conversation. Let's start a community over here. For now, thank you so much for watching and stay tuned to Money Control.